Welcome to the Türkiye Executive Brief, your weekly guide to the key developments shaping Turkey's business and investment landscape. I'm your host, Ceyhun Emre Doğru, and I'm thrilled to have you join us as we cut through the noise and deliver the insights that matter most to executives and investors. This podcast is designed for decision makers who need clarity and context. In just 15 minutes, we'll cover three pivotal topics each week, ranging from economic trends and policy shifts to industry updates and geopolitical developments. Our goal is simple: to help you stay informed, spot opportunities, and navigate the challenges of doing business in or with Turkey. Whether you're a seasoned investor, a corporate leader, or simply someone with a keen interest in Turkey's dynamic market, this podcast is for you. We focus on what you need to know, why it matters, and how it impacts your strategies. So without further ado, let's dive into this week's Türkiye Executive Brief. Today is November 29th, Friday, and in this episode, we'll cover three critical topics. First, the expectations around an upcoming interest rate cut by the central bank and what it could mean for the economy. Second, the government's decision on the minimum wage increase and its implications for businesses and households. And finally, survey results shedding light on the Turkish public opinion regarding the economic sentiment. Let's start with the first point. The Central Bank of Turkey recently maintained its benchmark interest rate at 50%, marking the 8th consecutive month without a change. However, the accompanying statement indicated a potential shift towards monetary easing in the near future, with many analysts forecasting a rate cut as early as December. But wait, why do we think so? To answer that question, we should dive into what the central bank had to say in its most recent meeting on November 21st. Here is the big picture. They noted, quote, "a decline has been observed in the underlying trend of inflation." Now, that's a major shift from last month when they said the underlying trend of inflation has increased slightly. So we have gone from inflation picking up to it finally slowing down. Then they talked about domestic demand. Last month, the statement was cautious. Quote, "third quarter indicators imply that domestic demand continues to slow but has not yet reached levels that would support a decline in inflation." And what happened this month? The tone is much more optimistic. Fourth quarter indicators imply that domestic demand continues to slow and has now reached levels that support a decline in inflation. So, what does this mean? Let's break it down. First, the central bank is saying that inflation is easing. The central bank believes the worst of inflationary pressures may be behind us. That's a huge shift. It suggests the policies they have implemented so far, whether it's high interest rates or tighter financial conditions, are starting to pay off. Second, domestic demand has stabilized. People and businesses are spending less, which reduces pressure on prices. Last month, the bank wasn't quite sure demand had slowed enough. But now they are confident that it's at the right level. Here is where it gets interesting. Could this set the stage for a rate cut? I posed this question to Emrah Lafçı, a Turkish economy and financial markets analyst. So Emrah, what do you think about a possible rate cut in Turkey in the coming months? Are there indicators to assume that it will happen soon?
The central bank kept the policy rate constant at 50% in its Monetary Policy Committee meeting in November. The interest rate has been at the same level since March 2024. The central bank had provided guidance in previous announcements that inflation would approach 1.5% per month in the last quarter of the year. Despite this, we saw that inflation was close to 3% per month. This caused the date of a possible interest rate cut to be pushed back. Year-end inflation will probably be close to 45%. The compounded version of the central bank interest rate is close to 65%. The central bank's inflation estimate for 2025 is 21%. Therefore, whether viewed according to realized or expected inflation, a policy rate of 50% and a compound interest rate of 65% are quite high, and there is a mathematically room for a limited interest rate cut. On the other hand, according to the survey conducted by the central bank, market participants' inflation expectation for the next year is 27.2%. The real sector's expectation is 47.8%, and the household's expectation is 64.1%. This shows us that the central bank has not yet been successful in managing expectations for large segments of the society. Under these circumstances, although a rate cut in December seems mathematically reasonable, I think it would be more appropriate to wait for the new year due to Turkey's special conditions. It would be appropriate to see the wage increase that will be determined for the new year and then make a decision. Long story short, January 2025 is going to be better for the rate cut.
Lowering interest rates would make borrowing cheaper, which is great for businesses and households looking to invest or spend. But, and it's a big but, it could also put downward pressure on the Turkish lira. That's a risk Turkey has to manage carefully. Well, of course, representatives of Turkish businesses are also closely following the central bank's evolving stance. For them, monetary policy decisions aren't just announcements. They shape the real economy they operate in every day. To understand how Turkish businesses see the situation, let's look at two different institutions, TÜSİAD and MÜSİAD. For those who are not familiar with these two, TÜSİAD represents large established businesses with a focus on free market principles, global integration, and democratic reforms, emphasizing secular and Western-aligned policies. MÜSİAD represents small and medium-sized enterprises with a focus on combining free market practices and social justice, mostly rooted in conservative values, often aligning with traditionalist political stances. No wonder why they think differently on policy rate. To understand the differences, let me share with you the recent remarks of their chairpeople. TÜSİAD chairman Orhan Turan took a more cautious position against interest rate cuts. He said an early interest rate cut could harm the economy and progress we have achieved so far and prolong the disinflationary process. As we are already starting to feel the cost of this process, especially in the industrial sector, though high financing expenses and slowing demand, we must be extremely cautious in managing it correctly. Inflation control has so far primarily relied on monetary policy. While we have seen the positive effects of the right steps taken in this area, achieving the target, which is 21% inflation rate for next year, may require more than current policies. So he says fiscal policies need to implement this process, need to be implemented more effectively. This means prioritizing tighter control over public expenditures, redirecting them to more efficient areas, and significantly strengthening efforts to combat the informal economy. So, long story short, TÜSİAD says that first, caution against early interest rate cuts, second, monetary policy alone is not sufficient, and third, need for stronger fiscal policy measures are required. As opposed to this, let's look at what MÜSİAD chairman Mahmut Asmalı said. He basically says that if inflation drops below 47% in December, he expects a symbolic interest rate cut. However, he says, quote, I believe the pace of rate cuts will pick up more significantly in January, February, and March. So, looking at the recent data, central banks' indicators and expectations of businesses, it seems that we are likely to see a modest interest rate cut in December. We'll keep you updated about indicators that may prove or challenge our current statements. Now, let's make transition to our second topic, the debate around minimum wage, which is equally important and is very much related to inflation topic we just discussed. It wouldn't be an overstatement to say that this upcoming decision on the minimum wage is one of the most pivotal the government will make in the near term. Here is why. It's not just about the wage workers earning minimum wage, although they represent a significant part of the workforce, with nearly half of Turkish workforce currently earning the minimum wage. This decision directly affects millions of people. But the impact doesn't stop there. The minimum wage serves as a benchmark for salaries across many sectors. Whether you are in manufacturing, retail, or even in white-collar professions, wage negotiations often take the minimum wage as a reference point. An increase here can ripple through the economy, influencing wage adjustments and labor costs in every single industry. While a higher minimum wage can restore purchasing power and improve living standards for workers, it also raises significant challenges for businesses, which may struggle to absorb the additional labor costs, especially in a high inflation environment. The government must therefore balance the need to protect workers' livelihoods with the imperative to maintain economic stability and control inflation. This decision will have far-reaching implications, not just for minimum wage earners, but for the entire workforce and economy, making it a truly critical moment for Turkey. President Recep Tayyip Erdogan has addressed the upcoming minimum wage adjustment, emphasizing the government's commitment to safeguarding workers against inflation. He referred to the central bank's year-end inflation forecast of 44% and stated, quote, "will not let inflation crush our people." Well, that's obviously what you would expect a seasoned politician to say. But to understand the underlying factors, and let's look at the past practices and indicators and see if they can give us a better forecast about minimum wage decision. According to Turkish, a confederation of Turkish trade unions, as of October, the hunger threshold is slightly above 20,000 Turkish lira, while the poverty threshold is approximately 66,000 Turkish lira. Looking at past trends, we observe that the minimum wage has typically been set slightly above the hunger threshold, reflecting the government's approach to ensuring a baseline level of sustenance for workers. However, with inflation continuing to erode purchasing power, the pressure to raise the minimum wage is immense. If inflation trends persist, a 25% increase or higher in the minimum wage may be necessary not just to align with the hunger threshold, but also to alleviate the economic hardships faced by millions of workers. Yet, the central bank has a different view. For a long time, the central bank has argued against reactive minimum wage increases and instead advocated for adjustments aligned with target inflation. This argument, reiterated in November by Central Bank Deputy Governor Cevdet Akçay, suggests that if the central bank's inflation forecast of 21% or the minimum wage projection of 17.5% in 2025 were used as a benchmark, the minimum wage should rise to approximately 20,000 Turkish lira. However, these proposed increases based on inflation targets are unlikely to satisfy the demands of workers or unions. With actual inflation consistently outpacing projections, these adjustments may fall short of addressing the erosion of real incomes. If wages rise too quickly, businesses face higher labor costs, which could lead to further price increases, a cycle that undermines disinflation efforts. So, all this shows how critical the decision will be. Our expectation, given the balance between economic targets and political conditions, my understanding is that the minimum wage will increase somewhere between 30 and 35%. JP Morgan's 2025 year-end currency expectation is around 45 Turkish lira. So, a 30% increase in the minimum wage would correspond to approximately 22,000 Turkish lira. According to the medium-term program announced by the Turkish government, the projected average exchange rate for the dollar in 2025 is 42 Turkish lira, which would equate to around 526 US dollar. And given all these economic troubles and uncertainties, let's see how the Turkish people think and feel about the economic situation. Now, here I'm going to refer to the recent findings of Research Istanbul, a reputable public opinion research company. Compared to last month, there was a 2-point decline in negative evaluations of the current state of the economy. In November, 76% of respondents rated the current state of the economy either as very bad or bad. The rate of respondents who answered neither bad nor good was just 16%. Meanwhile, 8% of the respondents think that the current economic situation is either good or very good. So when we analyze the temporal change in the response to the question, how do you evaluate the economy today on a party basis, we see an expected result. The perception of the economy among the voters of opposition parties has been largely similar for many, many years. This month, 93% of all opposition parties had a negative evaluation of the economy. The group with the highest increase in negative sentiment is around 55 and 64 age group. In this age group, the rate of those with negative evaluations increased by 5 points to 76%, and this, I think, can be explained by the worsening conditions, especially by the retired people. So, are the Turkish people hopeful about the near future? Let's look how they responded to the following question. How do you think the Turkish economy will look like in a year from now? More than half of the respondents are negative about the future of the economy. 58% of respondents think that the economy will be much worse or worse in the coming year. Compared to the last month, the rate of pessimism increased by 2 points. 23% of respondents think that the economy will remain unchanged in the next 1 year. So, in total, 81% of Turkish people think that the economy will get worse or stay the same at best in next year. And finally, can Turkish people make ends meet? A 56% majority of respondents said that their income did not meet their expenses in November. The rate of respondents who said that their income barely met their expenses became 29%. So in total, 85% of Turkish people say that they're struggling economically. And that wraps up this week's episode of the Türkiye Executive Brief. Today, we covered 3 critical topics. First, the central bank's evolving stance on interest rates and the big question of whether an early rate cut might derail the progress made so far. Our answer is yes, we can expect a rate cut, though it will probably be a modest cut around 250 basis points, and that decision is very much dependent on the inflation outcome in December. Second, the intense debate over the minimum wage increase and its implications for not just workers but the entire economy. Our expectation is that there will be an increase of 30%, which brings it to $526 based on the average currency expectation in 2025. And finally, what the Turkish public opinion reveals about economic sentiment that influence the business environment. The results show that the economic problems are the number one priority for Turkish people, as 76% of them saying the economy is in bad shape, 81% having no hope for improvement next year, and 85% saying that they cannot make their ends meet. Thank you for tuning into the Türkiye Executive Brief. Don't forget to subscribe, share this episode, and let us know your thoughts or questions. I'm your host, Ceyhun Emre Doğru, and I will see you next Friday.